Hi, Chris Christopher here. Thanks for joining us on our second video of this 4-part series titled Weaponize Your Mortgage. 7 steps how to make your mortgage into a money-making machine and how to escape the 9-to-5 daily grind. Let's have a look at them. Step number 1, understand your finances. Income. What is your income? Net disposable income, which means your income minus your mortgage and all your expenses. What are you left with? Your net disposable income. Assets. What do you have in the form of assets? Now, assets would look like an investment property, your own home, shares, car, anything of value that you could sell. Liability, any debts you have, in most cases would be against these assets. Let's use some examples. Your mortgage, credit card, home loan, for investment property purposes, personal loans, credit card debt, those sort of things. Your net asset position is basically your assets minus your liabilities. So let's use a few examples of them. I have a mortgage of, I have a home with $1 million and my mortgage is $500,000. In that case, my net asset position will be $500,000. Use another example. I have $100,000 in the bank and a $20,000 car loan. My net asset position would be my $20,000 minus my $100,000, $80,000, your net asset position. Your assets minus your debts. So as an exercise, I'd like everyone to get a pen and paper and work out what is your net asset position. Number 2 is know your current equity. Now, in most cases when we refer to equity, equity would be your equity you have on your own home or your investment properties, or as a cash deposit, that would be equity. Okay, now there's a difference between equity and usable equity. So let's use a couple of examples, and I'll use the same one in terms of your home being valued at $1 million and your debt is $500,000, you've got $500,000, so $500,000 worth of equity. Usable equity is usually 80% of the value of that asset. So in that case, of $1 million, 80% of that will be $800,000. If our debt is $500,000, our usable equity would be the difference between the two, which would be $300,000. Now, usable equity means you don't have to go into lender's mortgage insurance. And it also gives you a safe loan to value ratio. So we try to stick under the 80% mark where possible. Create the correct financial structure. One of the most important things when it comes to investing in real estate or anything for that matter is to have the right financial structure behind you. Now, I've helped many clients duplicate a successful process over and over again. Now, when I bought my first property at 19, the way I was able to buy 8 properties by the age of 24 was to get the right financial structure in place, which is very, very important. People say location, location, location. I say affordability, affordability, affordability is the most important thing. So let's look at a correct financial structure and one that we use for many of our clients. And in this example, it's called an offset account. So all your salary, in this case, will go into an offset account. All your other income, which will be the money that you're saving from your tax, from your investment properties, and the income that you got from your rental property will go into this offset account. Through that offset account, it will pay off your mortgage and will pay off your investment property. You will have a credit card which will use for all your expenses, which will pay your bills and your living expenses, and then up to 55 days interest-free depending on which lender you choose. So for 55 days, you'll have all your money sitting in an offset account offsetting your interest. So you'll be living off the bank's money for that period of time. Now, why that's very, very important is interest is calculated daily. So the more money we have sitting on our mortgage, the less interest we pay, and the quicker we can pay off our mortgage term. So this offset account is a very, very popular method. Now, building your wealth. Start to build your wealth. Step 4. Now, it's an obvious one, but spend less. Now, people go, but how will I spend less? The most important thing is to use a budget. And a tip that me and my wife do, we do a monthly budget meeting. Now, it doesn't have to be boring. We go to a nice restaurant that we like and we look over all of our figures from a personal perspective. We can see where we can save some money, and you weigh up the needs versus the wants. Half the time, saving money is just about raising an awareness to where you're spending money. I'm not telling you for 1 second to stop doing things that you enjoy. But if you buy, as an example, you go to 5 restaurants a month, maybe go to 4 restaurants a month or 3 restaurants a month. And with that 1 or 2 amount bill that you're saving, use that to save that money. Earn more. Now, how would you earn more in your current employment? There's a few ways. Upskilling yourself is probably the first way. To do courses and to become more value to that, obviously to that business. To generate sales. to work overtime. There's a number of different ways to get a promotion. Obviously, every year people usually get reviewed and things like that. And the third point is to save more. And for me, saving more is very, very important. And a good way to do this is to make sure that you pay yourself first. One of the best books that I read earlier on in my career is called The Richest Man in Babylon. And part of this book, it says to pay yourself first. Now what that means is to make sure no matter what you earn, a small portion of that comes back. Now starting at 5% is a good amount, but you'll eventually want to get it to 10. And if you can go to 15 or 20, it's even better. Of the amount that you earn, you save it towards whether that be your mortgage or investments. Now the beauty of that is after the period of time when that compounds, and we're going to talk a little bit about compounding later, that's when you will truly start to build your wealth and become wealthy. Okay, and that's how when I bought my first investment property at 183,900 in South Tweed, and I sold it a few years later for 328,000, which was a 480% return on my investment when I put 30,000 down, and I duplicated that process. That's how I bought 8 investments, and that's how I've shown thousands of clients to do it as well. Now, Reventon was started in 2005, so not only am I a product of the product and I can show you exactly how to do each of these steps, I've helped thousands of clients, and that's what I'm most proud of as well. Now, step 5 is to do your research. Now at Reventon, I'm going to share with you a little bit here and in my next video, so make sure you don't miss that, exactly what sort of research methods we use, and a little bit of our secret sauce, which is also shared by the RBA and can predict the top 100 suburbs with a 91% accuracy rate, and they can also predict future growth patterns by using a mathematical algorithm determining on where it's going to spend infrastructure and so on and so on. And it's one of our methods on how we do our research, and it's something that I'm going to share with you as well. Now, I mentioned compound growth and how important it is. Albert Einstein calls this the 8th wonder of the world. Those who understand it, earn it, compound growth, those who don't pay it. Now I'm going to use an example of a piece of real estate worth $500,000 at a 5% capital growth rate, what that does in 10 and 20 years and how that grows. Now remember we said compounded growth is growth upon growth. Let's use that and see this in this example. 500,000 is the asset. In 10 years at a 5% growth rate, that asset's worth 800,000. So it's grown 300,000 in the first 10 years. Watch what it does in the next 10. Now as we said, property's not a get rich get quick scheme, it's planning better for tomorrow, 10, 20 years and so on. From 10 to 20 years, it's gone from 800 to 1.3 million. So it's grown 500,000 in equity. So just to recap that, the first 10 years it's grown 300,000 in equity. The next 10 years, due to the value being high, it's grown 500,000 in equity. That's compounded growth. Now that's on one piece of real estate at 5% growth rate. Imagine 2 pieces of real estate, 3, 4 or 5. Imagine a 6, 7, 8% return. Now we're showing our clients how to get 12% returns, just to give you an example. Now, I'm going to give you some example in today's market. Now if you look at the last 3 years alone, what all these examples are from, we've had APRA tightening lending. We've had the Royal Commission hearings. We've recently had an election. We've had most capital cities go backwards in value. We've had a ton of negative media. But let me show you what we've been able to do with our clients and what I've been doing for many years in today's market that are having 12% growth rates. Let's have a look at these examples. Here's 3 examples of a client that bought in 2016 a property in Marshall for $385,500. Valued today at $495. That's 107% capital growth. Second property, January 2007 in Mountain Eat, 217, sorry. Valued today from 560 purchased to 680,000. That's just under 120,000 in capital growth. Third property was purchased at 449,000 in January of 2017. Valued now at $550,000. That's $100,000 worth of growth. Now in the last 3 years, this client has made $327,000 worth of growth from an investment of $339 at a 20% deposit rate. That's just under 100% growth in today's market. Let me use another example of a client which we'll go into in the next video. Graham and Tanya Lineker came to us with a 14-year mortgage of $200,000. We smashed their mortgage in 6 years, paid it outright. They've since bought 2 investment properties and made $300,000 in growth. So just to recap that, came to us with a 14-year mortgage in today's market, paid it off in 6 years, put 2 investments behind it and have made $300,000. We've shown our clients to do that, and we'd like to show you as well. Imagine if you could do that with your finance, what a difference that would make to you. Now, step number 6, and we covered this a lot in your first video, getting your money to work for you. How to get a $400 a week passive income without doing 1 minute overtime and avoid the 9 to 5 grind. Now, as we said, that's with one property. Imagine with 2 at $800, with 3 at $1,200 a week, with 4 at $600 a week of passive income. What difference would that make to your life and lifestyle or your mortgage? Now, the 7th step, which is obviously equally as important as ever, is to rinse and repeat, which is mean to repeat a successful process. One property is not going to allow you to retire financially secure, neither is 2 or 3. Yes, it will get you closer, but we need to keep going with that strategy and to keep. Now at Reventon, we do 6-month reviews because that's very, very important. To not get you into the first investment property, but to get you into the 2nd, 3rd and 4th. Now, my 3rd video installment, how to find your first profitable investment property. I'm going to show you exactly how to get into the market. This is one you're not going to want to miss. Thank you.